We're doing today's video a little different than yesterday's video. I haven't yet listened to the Meta call, although I've taken a look at the report online. And I think it's more of the same than we got yesterday. Better than expectations, although not so much better than expectations. And it's not like this report takes us back to the past Meta that was growing at 20 or 30%, that was dominating the internet and going to take over the world. This is a Meta that is largely flat. I mean, we can go over some of the numbers right now and just take a look and see how things compare. Look, like revenue, 27.9 last year, 28.6 this year. This company is priced for deep, heavy, double-digit growth. Let's see. Revenue up 3% year over year. I mean, that's nothing. What's inflation? Inflation's higher than 3%. Whatever is what it is. Better than expected. People were fearing a lot. However, at the same time, the stock is also up before this report, 74% year to date. That is a big, healthy run. I'm not trying to say that past performance is, going to necessarily impact the stock. What I'm trying to say is this company, Microsoft, Google, Apple, etc., they are very expensive relative to the S&P 500. The S&P 500 is, I believe, slightly below 18. Meta, 24. Before today's move, 24. Google, roughly 25. Microsoft, 30. Apple, 27, 28. Something like that. So these companies are close to almost double the S&P 500 multiple. Some of them are that much above the S&P 500 multiple. However, these are no longer out of the ordinary growth rates. These are very much normal S&P 500 growth rates. So for them to get such an aggressive premium, I think is a little uncalled for, in my opinion. I think there has to be a re-rating there. I think overall, for the S&P 500, there probably has to be a re-rating of the multiple because interest rates have gone up. Multiples and interest rates are very intertwined. The amount of time you're willing to wait, because at the end of the day, this is what it's about. The amount of years you're willing to wait for that company to generate the cash that you're valuing it at. So how many years? 24 times earnings. You have to wait 24 years for that company to make that money back in terms of earnings at the current levels. Obviously, that's a long time. That's basically not worth it. 24 years just to break even. Why would you do that when you could buy 4% bond, when you could buy 8 or 9% real estate? So yeah, you do the math. It makes a little more sense once you start doing the math. However, it seems that the market is not doing that as much. It's moving the stock up 10% on top of 74% year to date on 3% revenue growth. Earnings decline. I believe that's the case, earnings decline. It's actually quite a healthy earnings decline. Last year, Meta made $7.465 billion in net income in the quarter that ended March 31st. In 2023, Meta made $5.709 billion. That is a 24% decline in earnings. And the stock is up 10% today. In addition to being up 74% for the year. Now, obviously, at the lows, it was quite cheap. It was, 11, 12 times earnings. That is low. I'm not saying they don't produce money. They're producing money. But they don't deserve an above average multiple. I'm sorry. Why don't we give this kind of multiple to Cleveland Cliffs? Why don't we give this kind of multiple to ExxonMobil? Why don't we give this kind of multiple to GM? You know what GM's multiple is? It's like less than 6. So for Meta to be 4 times that, GM is growing its earnings right now. I'm just hesitant. I definitely don't want to own this stock. I'm not short Meta. but I definitely am not compelled to buy it here. You know, if you've been watching this channel for a long time, you know in the past I would say mega cap tech. I never felt like those companies were really growth companies, and it's for this reason. They're simply not growing that much. They're simply not growing that much. So my take on the earnings thus far, for what it's worth, is that yes, they're better than expected, but they're still suffering from the problems that we've talked about before. These companies are not growing at the rates they were growing at. However, the multiples are still near all-time high multiples for these stocks. The exception of Meta, but it's still high, and it has its own reasons not to be trading at that multiple. No stock should be at the multiples they were in November 2021, obviously. So I think there's a meaningful re-rating that needs to occur for stocks. I think that's something that has to happen in order for me to be compelled to buy, for the market to trade where it should trade, and to actually provide a return to the investors who invest in these companies. However, I've been parroting this all year, and it's been a very brutal year for me. So take what I'm saying with a grain of salt, because we're about to be in May. That's month number 5. That's 4 full months of being wrong. It's a long time to be wrong, and I admit that, obviously. So I have to be humble with myself and say I don't know when this is going to occur. My assumption was it was going to occur with earnings. Now we're seeing some reversals, Google reversing. They're doing some accounting funny business. I think it's pretty similar to Meta, although no accounting funny business. But in terms of the growth rates, I mean, they both have 3% growth rates, 6% in constant currency, 3% growth rates in US dollars. And the US dollar might go up. Rates are low. I still believe rates are going higher. I believe the Fed is going to continue to tighten. I still believe oil is going to remain imbalanced. I get it. The past action of the past 2 or 3 days doesn't signal that. There's definitely been a recession trade going. Yields have fallen. Oil has collapsed, basically, even though it's been green at points throughout the past few days. So it's a really strange time in the market right now. Really strange time for me. It's not fun being me right now. I can tell you that. But I'm doing the best I can to analyze this market. And my belief is many stocks are very expensive. Many stocks have run up very far this year. That would make sense if the economy was growing a lot and expected to continue to grow. That would make a lot of sense if these companies were growing earnings a lot and were expected to continue to grow. However, these stocks that we're talking about, and we've been talking about the past few days, are the biggest companies in the world. They're very large, and they're not going to grow that much, it seems. They're not growing right now. They're experiencing things they haven't experienced before. Google, for the first time, has experienced back-to-back quarters of declining ad revenue. I believe that was the case, or declining ad earnings. That is the first time that's happened for Google. And those are 2 out of the only 3 quarters ever that has ever happened for Google. The last one in 2007. So I would say these businesses, while they are big kahunas, they're quite expensive in my opinion. We know what's happening with the money supply. The money supply is falling. We know what's happening with interest rates. Interest rates are going up. So to buy stocks at near all-time high multiples with near all-time low growth rates, I think is a big ask. You're entitled to do what you want to do, though. And this is just my analysis of the situation. My analysis, while fundamental-based, is not always correct, as we can see, in terms of stock movements. We'll see if it ends up being correct in the long run. That's today's video. And until next time, peace out.